Hi everyone. In this session, we are going to talk about analysis of financial statements. So, three main kinds of financial statements that are useful to a financial analyst are income statement, balance sheet, and cash flow statement. And we're going to use those three types of accounting information um, and create some ratios, for example, uh, to learn more about how the company and how the manager is performing in different dimensions of a company's operations in terms of, for example, managing liquidity, managing debt, assets, and so on. So we're going to go over some of the ratios to understand the company's financial statements, and we're going to spend some time on understanding something called the DuPont equation. So the DuPont equation is a very nice way to summarize different types of ratios, broadly speaking, and understanding a bit more about what the company needs to do to create wealth, for example, for the shareholders' money. So after that, we're going to talk about a kind of a different tool, related a tool um, related to common sizing income statement and balance sheet. So how can we understand more about the company's performance by sort of standardizing in its income statement and balance sheet, and what are the things we can learn from it? Then in this process, we are going to talk about, whenever we get a chance, about different limitations of the analysis we are doing, specifically ratio analysis, and some qualitative factors we need to consider. So the message here would be that ratios and a common sizing, for example, income statement and balance sheet, are nice tools that allow you to ask some deeper questions about the company's uh, performance. However, these are not necessarily the final answers or clear-cut answers to understanding how the firm behaves. Okay, so the final objective of a firm is to maximize shareholders' wealth, which is basically increasing the free cash flows available to investors, uh, and minimizing the weighted average cost of capital or required rate of return, which put together will maximize this value. So free cash flows come from, for example, net operating profit after taxes, NOPAT. So in the ratio analysis, we're going to talk about profitability ratios. Then we're going to talk about, from that we subtract the required investments in operating capital. So how much investment is needed to generate this operating capital that will eventually feed into free cash flow. So for that we're going to talk about asset utilization ratios, how well this company utilizes its current assets and fixed assets and inventory to generate sales and eventually profit. And those will be the factors related to the numerator of this equation, free cash flow, dollar value. Also important are the risk count factors, right? The required rate of return, the rate of return investors would want from this company or a particular project, and that will depend on. So investors will be of basically two types: debt holders and equity holders, and the required rate of investors will depend on the riskiness of the company in terms of how much money it kind of borrows compared to equity. That will be financing risk, and also it has to do with how much business risk, how much operating risk it undertakes. And we'll learn about liquidity ratio, for example, to understand more of business risk, and leverage ratios and debt to equity ratios to understand the financing risk, and so on and so forth. So this chapter is going to contribute kind of meaningful into this equation. Okay. All right, so initially we start by talking about some ratios. So ratios try to assess the company performance or the financial manager performance in different dimensions related to liquidity, efficiency ratios or asset utilization ratios, and profitability ratios, for example. Then comes the market ratios and so forth. And you can use ratios to compare the company's performance over time, compared to itself in the past, or the company versus other companies or the overall industry. And the ratios are going to be important for many types of stakeholders. For example, lenders would want to know the credit worthiness of the company, whether the company is able to pay back on their interest and principals on time as promised. And to stockholders, obviously, to estimate the prospects of the company in the future in terms of generating cash flows on their investment and utilizing their capital well to generate revenue and profit. And managers to identify areas of weakness and strength and where do they need to work on to improve the company's performance. All right, so what we're going to do is we're going to go through an example of ratio analysis and standardizing or common sizing income statement balance sheet using the given data. Right, so the data on this slides are similar. They're the same actually as the data in the spreadsheet. So we're going to go work through this spreadsheet and try to discuss various aspects of what we calculate and how we interpret those things of different ratios and so on. So what I understand is for most of you this is not your first finance class, right? So rather than going over and you know about ratios to some extent and calculating ratio, the computation process is not really difficult, right? Especially if you are given formula. These are just two numbers, adding, subtracting, and dividing really. So rather than spending a lot of time in calculating each and every of this ratio and discussing them individually, we're going to go quickly through calculation and focus more on big picture and interpretation. Okay. However, I would want you to go over all of the calculations and make sure you finish it. And your guide will be these slides. So the slides have the answers to all of these questions, right? And I want you to finish and submit it as a part of class participation. But in this video, I'm not going to go over them necessarily individually in detail, however, focus on interpretation and understanding. So what we have here is balance sheet. So balance sheet, as you know, has two sides: assets. So what does the company own in terms of assets? So could be liquid asset, cash, short-term investment, accounts receivables, and inventories in the process of operations, and then those will be total current assets, and then fixed asset in terms of property, plant, equipment, buildings, etc. So these are the things that the company owns to produce revenue, and somebody is financing them, right? So in order to buy those stuff, you need investors. So the balance sheet, liability, and equity side tells you how these things are financed, and some of these things are financed, for example, by suppliers. So that will produce accounts payable. So when you buy stuff on credit and haven't paid, will be accounts payable. Notes payable will be short-term loans from the banks and so on. Accruals are the wages, for example, payables, and salary payables that you have not you have accrued but you have not actually paid yet. So kind of your employers are financing you in some ways. So those will be current liabilities. Then the main long-term financing sources will be long-term debt and common equity, right? And any earnings this company has retained over time as opposed to distributing as dividends. Okay. So balance sheet is snapshot of assets and the financing side, liabilities and equity, whereas income statement is a flow statement, right? It has a period attached to it. So during that year, for example, how much revenue it generated and what different types of costs incurred in terms of operating costs and non-operating costs, including interest. So we are going to and some other information related to the market and dividend payment and so on that might be useful for further analysis. Okay. So the first set of ratios we are going to think about and calculate are called liquidity ratios. So the liquidity ratios basically say, okay, about what we call short-term solvency. Okay, can the company meet its short-term obligations given its resources right now or resources in hand? Okay, so there are two types of liquidity ratio: current ratio and quick ratio. So current ratio basically means the ratio of current assets and current liabilities. So what I'm going to do is just like before, I'm going to select this entire row, and I'll go to view and split, right? So if I split it, then I can move. I'm gonna use these statements here. So if I split it, I can work independently here, and I can actually move this view over and under. Okay, so I'm gonna calculate liquidity ratio. So for example, 2017 is already here. Let me go ahead and do this again anyways. So liquidity ratio is current ratio, and the formula is given here. Okay, current asset, total current asset will be will come from balance sheet. Total current asset is that $1.1 million total current assets divided by current liabilities. Okay, so current asset divided by, so I'm gonna go, then I can hit the arrow button here and go down on the list. Total current liabilities of that year 2017 is that much, 2.33. all right, and then I can, once I have this, I can drag it across and get the same numbers, these ratios for 2018 and 2019 projected or estimated, and compare it to the industry averages are already given there. So okay, so this is the ratio of current assets and current liabilities. So basically means whether the company has enough current assets such as cash, accounts receivable, and inventory, so that it can if to satisfy current liability, in the sense that if the suppliers kind of push for payment and accruals push for payments, can it meet its obligations easily using current assets. So in general, larger the ratio, the better the liquidity position of this company, according to current ratio. Although you have to interpret this ratio with caution, because this can also mean other things. Okay, so quick ratio is similar to current ratio, except it ignores inventories, subtracts inventory value from current ratio, from current assets, because inventories are one of the most least liquid assets among cash, receivables, and inventory. Basically, liquidating inventory means selling inventory, or sometimes selling inventory quickly, probably at a discount to gather some quick cash. So quick ratio will be total current assets minus inventory, all right, divided by current liability. So I'm going to go here and find the current liability number, total current liabilities, and 0.85, and I can drag it across and get the number. Okay, so this company only has like 50 cents in 2019. If you look at it, it has like 93 cents of current asset except inventory for each dollar of current liability. So compared to industry, which has 1-to-1, its liquidity position is not as good. All right, it's kind of improving, from 2018 to 2019, but it's still worse than the industry. So this company is not as healthy as the overall industry in terms of short-term solvency. Okay, so next class of ratios are what we call the asset management ratio. Now, asset management, why are those important? Those ratios tell you how the company utilizes its assets in generating revenue. Pretty much all of the ratios that you'll see in terms of asset management, broadly speaking, has total asset in the denominator of some type. Okay, so except in some exceptions we'll talk about. So total asset turnover is sales over total asset. Inventory turnover is cost of goods sold over inventories. Inventories are also kind of assets, right? Fixed asset turnover, sales divided by fixed assets. So what they're doing is comparing the company's like a revenue, for example, sales compared to the assets it's on. So what's wrong with, so obviously that what you can see is bigger these ratios, the better. In other words, it's better if the company has less assets compared to sales. So you might ask, like, what is wrong with having a lot of assets? For that purpose, you have to remember that, right? So these assets are what the company owns, and those assets are financed by somebody, stockholders and bondholders. Hence, they will demand a return on their investment. So the more they have invested, the more return they will demand. All right. So that's why an efficient company will utilize its assets to the best extent possible to generate revenue. So those asset management ratio will be along those lines. So the first one is inventory turnover ratio, which basically asks like how well this company utilizes inventory to generate sales. So I'm going to do 2018. So inventory turnover ratio will be cost of goods sold divided by inventory. So cost of goods sold is a flow item. So within that year, how much money worth of stuff they sold, right? So cost of goods sold data will come from income statement of that year, 2018. So I'm grabbing 2018 cost of goods sold. In this one, it excludes depreciation. Sometimes it can be a part of cost of goods sold, but don't worry, just say cost of goods sold divided by. So this is how much so this is not sales, but this is how much they bought and like kind of paid for to manufacture it. All right, so cost of goods sold divided by inventory is how much dollar worth of stuff they keep in their inventory on average. Okay, so that's a static item that comes from the snapshot item that comes from balance sheet. All right, the inventory item we can go and check here. Accounts receivable accruals, inventory. Where is it going? Inventory. So that's cost of inventory turnover in 2018, 3.87. So that means what that means is one way to think about it is, all right, this year, 2018, they were able to turn over, so exhaust their inventory almost 4 times. Throughout the year. Okay, so compared to cost of goods sold, inventories were cost of goods sold were 4 times the average inventory amount. So they were able to turn over the inventory 4 times. All right, so bigger ratio means this company maintains small amount of inventory to generate large amount of sales, which means it sells kind of quickly. Doesn't hold a lot of inventory to make sales. All right, in 2019, it was actually it's projected to be much lower, and compared to industry average, is much lower. So that means this company uses too much inventory on its shelf to generate sales. So it's slower in turning its inventory into revenue. Okay, the other ratio kind of related to asset management, or more specifically, management of accounts receivable or credit sales, is something called the days sales outstanding. This ratio will tell you on average how long this company takes to collect cash from its sales. So a lot of companies have to sell stuff on credit to attract more customers, and it's a kind of investment, right? So you have sold your stuff, but you have not collected cash, so you have to get it financed somehow. So ideally, you don't want any days sales outstanding. You want it to be 0 if you can sell in cash, but you have to sell on credit, but you want to collect as fast as you can. All right, so that ratio is calculated as, so days sales outstanding will be in days. So these are 37.4 days, 32 days, for example, and it's calculated as accounts receivable balance, and that will come from accounts receivable balance will come from the balance sheet. Okay, so for 2018, account receivable balance was $632,000 divided by daily sales. Okay, so how many days worth of account receivable does the company hold on average? So for that, the denominator has to be daily sales. What we have is not really, we have an annual income statement, hence annual sales, but we can infer the daily sales by doing, okay, divide that by annual net sales of 2018. Okay, so this is annual sales, and divide that by 365 to infer daily sales volume. So on average, this company takes almost 40 days to collect its receivable. In 2019, it's kind of projected to be even do it even more. Okay, so this company has a lot of money stuck on receivables. All right, it takes more time than the industry to collect its debt. So we can say collect its payments. So we can say it has to do better here in terms of collecting its money. Okay, fixed asset turnover has to do with how the company utilizes its fixed assets such as property, plant, and equipment to generate sales. Okay, how well it utilizes this property. And the formula for fixed asset turnover is just net sales divided by total fixed assets. So net sales divided by total fixed asset, that comes from the balance sheet. The total fixed asset will be property, plant, and equipment, mainly speaking. That comes from the balance sheet, net fixed assets. All right. The total divided by this number, and the total asset turnover has to do with all kinds of assets. So revenue divided by sales divided by all kinds of assets, total assets. So which will be this number. All right. So I'm not going to do the calculation, show you the calculation, but you guys should do it by using this formula. So what that tells you is, all right. So in 2019, for example, the company is expected to have 8.4 times as much sales compared to the assets they have used, whereas the industry average is 7. So they are doing it better than the industry. They are producing more sales given $1 of assets compared to the industry in terms of fixed assets. All right. However, in terms of total assets, they are doing worse. So the industry is producing 2.5 times sales compared to total assets, where this company is projected to do only twice. So the difference comes from, as we kind of saw before, inventory, right? So they have too much inventory per dollar of sales. So looks like they have to do something about inventory management. Okay, try to sell stuff more quickly so that they have less in inventory at any given point in time. Okay. All right, so the asset management ratios are important because it tells you how well this company is utilizing its assets financed by the investors in generating revenue. Okay, the other big important type of ratios are then debt management ratios. So first, it has to do with how much debt or what percentage of this company's assets are financed by borrowed money as opposed to owner's money, equity, and how well this company has been able to serve the debt. Okay, has it been able to? Is it in a good position to pay its interest or any of the principal payments or lease payments on time, given its operating income? Okay, the first one is just simply called the debt ratio. Okay, so how much is the company's total debt compared to its assets? Okay, so in this book, this book kind of differentiates between total liabilities and debt. That's okay, but sometimes some authors treat them as like a similar thing. So for this book, so debt ratio is total debt to total asset ratio, and this book kind of includes, for debt, it includes basically two types of things. One is the long-term bonds. Obviously, this is a type of debt, right? Since the company has borrowed money, plus notes payable. This is kind of short-term borrowing, maybe from a bank. Okay, so these type of long-term bonds and notes payable will be the items of debt, whereas total liabilities will also include other types of liabilities, for example, accounts payable, accruals, and so on. And some authors treat them as the same thing. Here, this author treats them kind of differently, but that's okay. So the total debt ratio for the 2018 was total long-term bonds. All right, long-term bonds. So I'm gonna add this long-term bonds plus notes payable. Divide that by, so the same thing, total liabilities and equity versus total asset, they are the same thing, but let's do the total asset here. Okay, so 35.6. Oops, I did the 2017 again. So make sure you do the 2018. I think you can actually move it like this, but you can actually redo it and do this whole thing all over again. So in 2018, the debt ratio has actually increased from 2017, and it is projected to go down next year because this company is doing some sort of restructuring, paying back some of its debt and issuing more equity. Okay, so why does the industry? So it's getting closer to the industry average in terms of total debt ratio. Okay, so is having a lot of debt good or bad? So we're going to talk about like merits of using debt, why companies use debt, and what are the risks, what are the benefit. In a little bit, especially in the use of DuPont equation later on. But right now, it looks like this company will have like less debt than the industry average in 2019, kind of improvement from previous years. Okay, in terms of total liability ratio, total liability is just basically total liabilities except equity, right? Total liabilities. So in 2000, this is the 2018 data divided by total asset. Okay, so liability include debt and other liabilities. So 80.7% in 2018. It's going to go down to 43.8% in 2019, which will be less than the company's the industry average. Okay, so the next two types of ratios have to do with whether this company makes enough money or to service its debt obligations. Okay, and how well the company can do it. Okay, so the first ratio related to this is something called time interest earned, and it's a very straightforward ratio. This ratio is just EBIT, or what we call the operating income, divided by this company's interest expense. Okay, so let's do this calculation quickly and understand what it is. So EBIT of that year, okay, earnings before interest and taxes for year 2018 is 17,440. Okay, so that's the operating income, so income before interest. Divide that by its interest obligations. Okay, interest payment for that year, which is 176,000. So this year 2018 was bizarre, but let's look at 2019 and so on. Okay, so what does 2019 this number mean? Okay, so this number in 2019, the time interest earns ratio of 6.28 means this company generated 6.2 times, let's say more than 6 times in earnings compared to its interest obligations. That means, this company in that year will be very comfortable paying its interest from its operating profit, because it has this 6 times cushion. So which is going to be slightly more than industry, which is great news. 2018 it was bizarre because this company, what that means is company only generated 10% of its interest expense as earnings. So its earnings were not enough to cover interest expenses. Hence, things started to go negative after interest expenses. As a creditor, you want to see a higher ratio to give you more assurance that this company is likely to pay your interest back on time. Okay. EBITDA coverage ratio is similar to interest coverage ratio or time interest earned, but it includes like other types of debt obligation or debt-like obligations. Okay, so first difference being in the numerator, instead of having EBIT, which is like a accounting term, right, which includes depreciation, non-cash expense, it will EBITDA. The numerator will be earnings before interest, taxes, depreciation, and amortization. Will also include like add back depreciation and lease payments, like which is non-operating expense, and compare that to all sorts of debt obligations, which could be interest payments as well as part of the principal payments and lease payments. Okay, so EBITDA coverage ratio will be, for 2018 will be the numerator will be EBIT. Okay, so earnings before interest and taxes, parenthesis because it will include a few things, E55 plus depreciation, add back depreciation, because depreciation was a non-cash expenditure, so this company probably has more cash than its profit shows, because a lot of those were depreciation expense, plus lease payment, because add back the lease payments, because lease payment is a non-operating payment, and we're gonna add this later on the denominator anyway. So add back lease payments, and lease payment is actually given separately somewhere. Okay, 40,000 lease payments is within the income statement. Lease payment is somewhere clubbed together in one kind of expense, but it's not given separately. Here it's given separately. Now divide that by, so this is how much you have available to service your debt. Divide that by your debt service obligations. That includes interest all right, then plus principal payment. Okay, I checked the principal payment is not given as a separate item, so we're going to assume it's nothing. We don't know. Okay, so after principal payment, add the lease payment. So interest plus lease payment. So lease payment is given. We added the lease payment up there, so which is also E19. Okay, so that will be, so if you come look at all types of debt service obligations, again 2018 was bad. In 2019, however, the company is going to be more comfortable. It will have more than 5 times in EBITDA compared to its debt coverage in 2018, which is better but still less than the industry. Now debt ratios, these are related to borrowing money and the ability to service debt obligations. Okay. Now next set of ratios, they have to do with profitability. How much profit this company made compared to sales, in terms of net profits, in terms of gross profit, in terms of operating profit. So first will be compared to margins, or when you compare them to sales revenue, and earnings powers, and return on equity and return on debt, return on asset are how much profit compared to total assets. Okay, so first one has to do with operating performance. The second one has to do with asset utilization to generate sales. So the net profit margin, net income, okay, the last, basically you can say last item in the income statement divided by sales. Okay, the net income of this company was actually not positive but negative. Net income here before preferred dividend. Don't worry about this because net income is reported as before preferred dividend. Preferred dividend is not an income statement item. Okay, net income divided by sales. Okay, again 2018 is a weird year, so this company made like a net sales, so negative 1.6% in net income. It made a loss of negative 1.6 in 2018. In 2019, it is expected to make 3.6% in net profit margin. So its net profit is going to be $3.6 for every $100 of sales. Okay, now let's look at other two ratios and then think about the differences. So let's look at the gross profit margin. So what is the gross profit margin? Gross profit margin is gross profit divided by total sales. So gross profit has to do with sales minus cost of goods sold, right, divided by sales. Okay, so the gross profit margin for 2018 will be, all right, sales minus cost of goods sold, all right, so direct expenses you can say, divide by sales. The numerator will be the same thing, so 14.6. so let me drag it across. 2019 is going to be 17.6% and so on. Okay, so what do we see here? So gross profit margin for 2019 is going to be 17.6%. So what that means is for every dollar of sales the company makes, its gross profit was $17.6. $17.6 cents. But net profit margin was 3.6% only. So what makes the difference between these two? So what can we learn from these comparison of these two ratios? The difference between these two are indirect costs and indirect operating costs, other operating costs, and taxes and interest, right? So if you compare to the industry, for example, this company's gross profit margin was actually slightly better, but ended up with the same net profit margin. Means that this company actually needs to do a better job of controlling its indirect costs, other operating costs, and probably interest expense. Okay. So gross profit margin, it has a higher gross profit margin, which means this company is actually slightly better than the overall industry in controlling its direct cost of acquiring probably merchandise and materials and so on. Okay. So operating margin is EBIT divided by sales. So I'm going to drag it across because EBIT you can find it from income statement, and sales you can find it here. I think gross margin and operating margin comparison is very kind of interesting, okay, because none of those include interest expense or financing expense. So this company has a higher gross profit margin but similar operating margin compared to the industry. So this company actually is better at controlling direct cost, but it is worse at controlling indirect cost or operating cost compared to the industry, right? Okay, these were how well this company utilizes its sales to generate income. Now it has to do with how well this company kind of manages its costs, right? So its operating costs, for example, and efficiency in managing operating costs. The other three ratios, they have to do with the same similar type of numerator, but assets or capital as denominator. Okay, so how well this company utilizes its assets in generating income. Okay, so the basic earning power, the first one has to do with how much operating income or EBIT this company makes per dollar of assets. Okay, again, why are assets important here? Because assets are financed by investors, and investors would want and bigger the asset means more financing has been done. So the company needs to make more money to satisfy the investors and so on. So basic earnings powers has to do with EBIT divided by total assets. So EBIT comes from income statement and total assets comes from the balance sheet. Okay. All right. So this company only generated 0.6% of EBIT compared to its asset in 2018. 2017 was much better. In 2019 it is going to be slightly better and still less than the industry. So that means this company is slightly inefficient in terms of using its asset to generate operating income. Okay, so this company is not working its assets well. It is not utilizing its assets to make money for the investors. So basic earning power, EBIT by total assets. Return on asset is very important number. A lot of analysts would like to calculate how well this company is utilizing its assets. All right, so fixed assets, property, plant, equipment, inventory, receivables, to generate the bottom line. Bottom line meaning net income. Okay, so the ratio is you can calculate the ratio as a net income divided by total assets. So net income comes from, so 2018 again is going to be weird. Net income divided by total assets, so it's going to be a negative number, really difficult to interpret. We can say it's bad, but so net income divided by total assets. So this company actually didn't do well in 2018 at all. Okay, but what does 2019 mean? So 7.2%. This company made 7.2% net profit compared to its assets. So it's a nice number because total assets represent total investments by investors. All right, net income represents how much money eventually was left out for investors. Okay, mainly for shareholders. This company made 7.2% of income compared to total assets. Now you can compare that 7.2% with how much investors would actually want on their assets, right? Okay, so that's the return on asset number that includes all assets, net income compared to all assets, and this company was not as good in terms of ROA. This company did worse than the industry. Okay, although it's done better than last year. Okay, one nice way to compare net income, which comes after paying for all sort of expenses, including interest expenses. So net income has already taken into account money that you pay to the bondholders. So one good way to compare return on asset, net income, is to equity holders' money. Okay, so rather than comparing net income with the total asset, you can compare net income to the shareholders' money or shareholders' equity. So net income divided by total equity, shareholders' equity, total common equity. Okay, so in 2018 a negative number, forget about that one. we know it's bad, but hard to interpret. In 2019, 12.8%. Now, this is a very interesting ratio. That means this year, the company made 12.8% on shareholders' money, right? Net income that kind of goes to shareholders or belongs to shareholders divided to our shareholders' money, which is common equity. Okay. Now, this is an important measure a lot of analysts would use and say, okay, this company was actually worse than the overall industry in making money for the shareholders. All right. Now, later on, we're going to talk about, like, okay, so what makes the difference between return on assets and return on equity when we talk about DuPont equation. But it looks like part of the reason this company has less return on equity is because this company also has less return on total assets. Okay. All right. So difference between the numerator here is total asset versus total common equity is basically the use of debt, right? Total asset will be both equity plus debt. Here we are stripping out the debt component, and this has implications as we see later on. Okay. The last set of ratios has to do with how the market values this company. Okay. So one matrix that is very popular in terms of market valuation is something called the price to earnings ratio. Let's just calculate this first. So price to earnings ratio is basically price per share. Okay. So how much does it cost to buy one share of this company? Price per share. All right. Which comes from the market, like stock market, divided by earnings per share. Okay, so which is net income divided by total number of shares outstanding. Okay, so the price per share does not come from the internal income statement, balance sheet, and cash flow. It comes from the market data, right? So year-end common stock price. In the last years, at the end of the year, the shares were trading at $6 per share. Okay, divided by, in that year, this company made how much money per share. So that will be earnings per share, and that is actually given below the income statement. So income data is available from income statement. So if you go to income statement, you can see, all right, 2018 EPS is earnings per share is right here. All right, negative number. Okay, in 2019 it's 12. Okay, so what does that mean? All right, this company is, all right, so net income, so earnings per share or EPS is how much money this company made for each share, all right, $1, and price is how much money are you willing to pay for the stock, right? In this case, happens to be $12, right? So what you're saying is, compared to this year's earnings, you're paying 12 times as much for this company's share. So it will take you 12 years, so to speak, to recover your share prices if all the earnings comes to you. Okay, now what that means is, compared to your current earnings, how much value this market is placing on your stock. Okay, so a bigger ratio, one interpretation is a bigger number means the company is putting a lot of faith in the growth prospects of this company. It's paying much more than its current earnings shows. All right, so the 2019 projected value is 12, which is kind of less than industry. So this company is kind of investors are valuing this company's prospects less optimistically compared to the overall industry. Okay, they're paying less per dollar of earnings. Now, another similar ratio is price to cash flow ratio. I'm not going to go into too much about in detail about this. So the only difference is in price to earnings, you take like net income as a denominator, whereas in price to cash flow, you take like cash flow or add back depreciation to net income. All right. So 2017. So kind of getting rid of the non-cash item and so on. So in 2018 it blew up because a lot of the expenses were depreciation expenses. 2019, if you look at price to cash flow ratio, which is some form of price to earnings ratio, you can say, it actually this company does slightly better than the industry. So there are a lot of differences coming from depreciation or non-cash expense. All right, market to book ratio is price per share, all right, in the market, how much each share is worth in the market value divided by how much each share is worth in book values. Okay, so when you talk about the value of the stock, you see two numbers at least, right? So value of the total, all the shares, one number is what you can see in the balance sheet, okay? Total common equity. So this is how much the shareholders claim is in the market, total common equity, right? Common shares divided by any retained earnings. So this is one value, but this value is kind of historical value in terms of how much money these shareholders contributed initially plus how much money has been returned. So you can compare this number to the how much value the market is placing on the company's stock by looking at the market value. So market to book ratio will be book value per share, basically per share basis, how much is the common how much is the common or stock worth. So total common equity divided by number of shares, and compare that to the prices. Okay, so I'll do this for 2018. So the market to book ratio, in fact it's useful to do this second ratio first. Okay, so the second ratio is book value per share. All right, so book value per share is in the balance sheet. What is the value of equity holders on a per share basis? So in 2018 this is like total common equity. Okay, this is value of all shares in the books, okay, historical value, divided by number of shares outstanding. It's somewhere here. All right, it's 100,000 in 2018. So in the books, every share was worth $5.58. In 2019 it will be 7.98. Now market to book ratio, you compare this value to the market value. So in the market value 2018, common stock price was 2018 was $6 in the book in the market, whereas in the books it was $5.58. So the market was it's usually, for a good company, you hope this number to be bigger than 1, obviously, because this market value has to do with the prospect of the company in the future, not in the past, where balance sheet shows you the past. If you drag it across, the valuation is going to be better in 2019, but still lower than the industry average. Okay, the final set of ratio we're going to talk about is not the ratio, but analysis related to the ratio is something called the DuPont analysis. Okay, so the DuPont system of equation, DuPont analysis is very interesting because it kind of puts together all the ratio of these companies to give you a better understanding about what this company needs to do to make to increase shareholders' wealth. Okay, so we're going to focus on one ratio that is widely used ratio called return on equity. Okay, so in terms of creating wealth for the shareholders, this ratio is kind of important ratio because it tells you ROE you have actually calculated. It tells you how much net income this company had generated in given year. So net income divided by total shareholders equity. So on shareholders money compared to shareholders money, how much profit it had generated for the shareholders. Okay, ROE, which you have calculated actually directly here. All right, for all 3 years we have already calculated the shareholders ROE here in profitability ratios, return on equity. Okay, 17, 18, 19. So in 19 the industry had like 18%, Computeron while had a 12.8%. The formula is net income divided by total common equity. Okay, now if you think about what makes up ROE, okay, we can break down ROE like this. Okay, so ROE is net income divided by common shareholders equity. Okay, CE, you can say CE. You can break it down ROE into 3 things like this: net income divided by sales times sales divided by total assets times total assets divided by common equity. Okay, so first off, mathematically, what does that mean? Okay, so sales cancels out this sales, total asset cancels out this total assets, and whatever is left over is net income divided by common equity. Okay, but then what does this ratio, what is the point of breaking it down? It tells you, okay, so in order for you to increase ROE, you want to increase each of these ratios. Okay, so in order to increase ROE, you have to increase this ratio. And what does this ratio tells you? Generate as much sales as possible given your total assets. So utilize your assets properly in generating revenue. Okay, don't don't use up a lot of assets, hence a lot of capital to make sales. Okay, efficiently utilize sales asset to make sales. Okay, now the second ratio, what does that tell you? Right, for each dollar of asset, generate more sales. Okay, the second ratio tells you for each dollar of sales, make as much profit as possible. This is the net profit margin, net income divided by sales. So the first has to do with asset utilization. Second has to do with controlling your costs. Okay, so what's the difference between sales and net income? Controlling all sorts of cost. Okay. Now if you just focus on these two ratios, what is this ratio put together? Sales cancels out sales, net income divided by total assets, which is actually the first part is ROA. Okay, so for you to have a bigger ROE, you have to have a bigger ROA too. All right, what about this third ratio? What does this third ratio tells you? The third ratio is total assets divided by common equity. Okay, given the same level of ROA, you can increase ROE by increasing this ratio. So what is this ratio? Total asset divided by common equity. All right, so what is the difference between numerator and denominator? When is this ratio bigger? Remember, total asset is financed by two sources, equity and debt. All right, now this ratio will be bigger if common equity is smaller. That means more debt. Okay, so equity multiplier will be bigger number if this company borrows more money compared to equity, or has a smaller equity compared to total assets, or has more debt compared to total asset. Okay, so in order to increase ROE, having a large amount of debt is also important. Obviously, debt has its own risks, right? That's why we talk about debt management ratios, interest coverage ratios. But what that means eventually is, okay, you want to make profit, but you want to make profit, you want to increase profit, but at the same time you want to minimize stockholders' own investment. That way you can make more money per dollars of shareholders' investment. Okay, so one important question you can think about is, given the same level of return on asset, how can you increase ROE? You can increase ROE by minimizing equity investment or increasing debt. Okay, so now you can break it down, these ratios, and these are the given example these are examples from our own data. Okay, these are already calculated. All right, so how does that come about? All right, so ROE, for example, let's do 2019. So let me go over this thing. Okay, so let's delete this and redo this 2019 data. So 2019, what was we already have calculated ROE, so we know this number already. So, but let's get ROE through this number. Okay, so what was the profit margin? Okay, profit margin, net income divided by sales, we have calculated here. Net profit margin 2019 was 3.6, right? 3.6% profit margin ratio. Total asset turnover. Okay, so we have that 2019 total asset turnover ratio comes from this ratio, asset management ratio. Total asset turnover 2019 2, right? So generating sales per dollar of asset times, last thing is equity multiplier. Okay, total asset divided by total equity. So that we have not calculated separately, but we can just from the balance sheet. Was that divided by total equity? Total common equity is that. Okay, so the difference is debt. Okay, so more the debt, bigger this ratio. Okay, now the multiplication of these three will be ROE, which is that ratio times equity multiplier 12.8%. Now you can verify that to the one you have directly calculated here, 12.8%. Voila, right? So spend some time kind of understanding the intuition behind DuPont analysis. Okay, I like this ratio. It's simple but powerful. Okay, all right. Now as a different way to do a financial analysis, different but related way is to look at a common sized income statement and common sized balance sheet, and also analyze the growth rate in the balance sheet and income statement item to understand what is going on with the company compared to its competitors or compared to itself, and we'll see what we can learn possibly from such a thing. Okay, so what is common sizing? So in common size analysis, all income statement items, right, are divided by the revenue. Okay, so everything will be expressed as a percentage of total sales, and all balance sheet items will be divided by total assets. So we're going to convert this dollar amount. All right, so every year it's going to look, the total is going to look the same, right, 100%, but these ratios are going to be different for each of the company in common sizing. Okay, so 2017 data is already given here. So I'm going to do it for 2018 and 2019, and industry data is already kind of given. Okay, but in the process, I want you to kind of pay attention to a few things kind of related to Excel tricks. Okay, so a common sizing statement, the balance sheet is straightforward. Okay, simple. Divide everything by that year's total assets, including total assets. Okay, so in 2018, so what I'm going to do is I'm going to say, all right, this number. So the actual income statement and balance sheet are in a different sheet, but that's okay. Okay, it will work out just fine. So I'm going to equal, all right, then go back to the balance sheet and say I'm going to divide total cash and cash equivalent. The items are the same. Divide that by total asset, okay, of the company. So which is this. All right. Okay, so 0.3%. So in 2018, cash and cash equivalent were 0.3% of the total assets. Okay. Now what we want to do is, this format is very similar to what we already see there. The items are the same. So what we want to be able to do is drag it down, but still divide everything by total asset item. Okay. So if you just drag down, it's not going to work, because these items will shift down. These items will shift down, which is what you want, but also this total assets cell will also shift down from here to here to here to here. Okay, it doesn't make sense that way. So what you're going to want to do is to lock this fixed total asset cell. Okay, so lock this cell E33 by doing $sign in front of, okay, to simplify stuff, $sign between in front of E column, in front of row E33. If you put a $sign, then that cell will stay the same. Okay, now things didn't work here, obviously, because this should have been 100%, but it's not. Okay, so one thing I didn't realize, I kind of misspoke, is the items over in the actual income statement balance sheet are not listed exactly similarly as here, because there are fewer items in terms of aggregation. It's the same balance sheet, but it's not as detailed as the actual income statement balance sheet. So for example, there is like gross fixed asset item, then less accumulated depreciation, then it does net fixed asset. But here you are just given net fixed assets. Okay, so you have to be a little bit more careful here than I wanted you to be. So we're gonna put the $sign here. However, we're gonna drag it down just to the right place, to total current asset, because up to here they're the same. However, for the next fixed assets, we have let's do it kind of let's do it separately. So for next fixed assets, equal net fixed assets will be, all right, 2018, this net fixed assets divided by total assets, E33. Let's do $sign one more time here. Okay, you can actually copy this part to make your life easier. And after net fixed assets, the next item is total assets, so I think you can just drag it down right here. So okay, so what you have to make sure is this, this is 100%, and match this up with the actual balance sheet items. Okay. All right, so liabilities and equity, they will be similar, but divide everything by total assets. Okay. Just be careful about the how the items are listed. So what I see is, okay, accounts payable, notes payable, accruals, then total current liabilities. Okay, so let's see, accounts payable, notes payable, accruals, total current liabilities, long-term bonds, then they have something called the total liabilities added together, which here it doesn't have that item listed separately. Okay, although the sum is the same. Okay, so what I'm going to do is all the way up to here I can drag across. Okay, so equal 2018, start from accounts payable, divided by total asset item. Okay, so I'm gonna lock this total asset so that I can drag it down again, dollar here. All right, and go all the way down, all the way to long-term bonds right here. Okay, total current liability. Okay, one more step, long-term bonds. Okay, so next item after long-term bonds will be total common equity. Okay, already added together total common equity, so which is total common equity. So I have to do it kind of separately. Total common equity right here, divided by total asset. That you can put a dollar sign here, but if you don't drag, you don't have to. So 19.3%, and drag it down 100%. Okay, so make sure this happens. All right, make sure the total is the total here. So if you just sum the total here, you will not get 100% because some of the items are already total. Okay, so total current liabilities here. Okay, once you have this, now you can compare. I want you to complete the 2019 item. Okay, look at the title 2019 items too. Now we can learn a few things about the balance sheet. Okay, all right. So one thing is Computron has higher proportion of inventory and current asset than the industry. All right, so it has compared to the asset, it is 44% in inventory than compared to the industry. All right, its current assets items are also higher in 2018, and I think it's going to be the same thing in 2019. So it has more current asset than in fixed asset. So what does that mean? I don't think that has a specific interpretation, except that this company might have been investing too much in inventory, for example, and too much in receivables, not collecting in time. All right. Now this company also has less debt than industry. So how do you know? So if you look at total total current liabilities, or if you look at long-term bonds, so in that 2018 it has actually more, but if you do it in 2019 it has less debt. Okay, and it has, even 2019 you should see that the Computron has more short-term debt, which will be notes payable, okay, compared to the industry. So I want you to complete 2019, and I'm sure you'll see that. And the way, and these calculations are the same as the calculations here, so you have a guide to go through. All right. Income statement, common sizing income statement will involve dividing everything by total sales revenue. Okay. So so we're going to look at what the income statement looks like. So actual income statement is longer, has more items and subtitles than this income statement, so we have to be careful about dragging it down. For example, it does not have, so net sales, cost of goods sold, depreciation, other expense, EBIT, so it goes to EBIT directly here, whereas here net sales, cost of goods sold, depreciation, other expense, total operating cost. So this does not have the total operating expense as a separate item, so you have to be a little bit careful here, but the same idea. In 2018, the first one is going to be 100% because everything is divided by sales, right? So 2018 is going to be net sales my goodness, it's look awkward, and divided by net sales. Okay, so it's going to be 100% here, but the denominator net sales we don't want to change as we drag across, so we're gonna put a dollar signs in here. Okay, so 100%, it says cost of goods sold except depreciation, so that lines up correctly. Depreciation lines up correctly. Then other expense lines up correctly, I think, right? Other expenses, all of these we could just drag it down if we put a dollar sign in front of sales. So everything is divided by E50. See, make sure everything is divided by E50. In this case it will be like F50, E50, right, or D50, but sales. Okay, then total operating cost is next item, but we don't have that in the common size statement. Okay, the next item is EBIT, so let's do it separately just to make matters easier. So EBIT, divide that by, again, sales, total sales. I'm going to put a dollar sign in it. All right. Then I think interest then comes after that, less interest, and I think pre-tax earnings also comes after that. So here, EBIT, less interest, less pre-tax earnings. Then taxes comes after that, so we can drag it down. And net income before preferred dividends, 1.6%. I think after that these are similar. Okay, so income statement ends here. So in fact I can do 2019 too kind of easily if I make just small changes. Okay, so let me just drag this across, right? So if I drag it across, what happens is because I have not locked the numerator, E goes to F, so here it becomes F50, which is fine, which is what I want for 2019 data. However, the numerator I want is not, it is locked to E50, but I want this to be F52. Okay. All right, so there are tricks to do this, but let's not complicate it. All right, so other expenses, EBIT, right, it goes all the way to other expenses, then we don't have total expenses. Now EBIT, then I drag across and make that E to F50. All right, then I think you can drag it all the way down to 3 point, all the way down to here. And 3.6, we have actually seen this. This is net income divided by sales, right? So we are dividing everything by sales, and we remember that actually the net profit margin was 3.6%. Okay, so what do we learn here? This company has cost of goods sold ratio compared to the industry. Cost of goods sold is lower, which is a good thing because they are able to control their direct cost better. However, they have higher other expenses than the industry. So non-direct expenses like overheads, for example, is higher. So that might be eating into their net operating net income. Hence, even if they have better gross income, they have more. They have similar, but they will have similar in 2019. They will have similar in net income because of other kinds of expense. Okay, the final way of analyzing the company's performance that we're going to discuss is to use growth rates in income statement and balance sheet. So by analyzing growth, we are also able to compare how the company has been performing with regards to different things. So analyzing growth will also teach us a few important things about this company's performance. So let's actually do that. So what we're going to do is we're going to compare growth to the previous years. All right. In 2017, obviously we cannot calculate growth because we don't have 2016's information, so everything is set at 0. But we can do that for 2018. So by what percent the asset or cash and cash equivalent grew. All right. So for that, what we have to do is be equal. You can. So this year's cash and cash equivalents, you can say mine divided that by last year's cash and minus 1. Okay, so it's the same thing as this year's cash minus last year's cash divided by last year's cash. It's the same thing. Okay, if you are thinking about that. So the cash actually decreased by 19.1%. Short-term investment account, receivable, inventories, total current assets, I think they occur like in this order, so I can just drag it down. I don't have to lock anything here because I'm comparing item to item. All right, so so inventory E28 divided by D28. All right, so inventory will be E28 divided by D28. All right, minus 1. So inventory increased and so on. Net fixed assets, so I have to be careful what I'm comparing here. So the next item, net fixed asset, is right here. Okay, so all these details are missing over there. So net fixed item I have to do E32 to D32. All right, so E32 to D32. E32, how much it grew, divided by D32 minus 1. Okay, so net fixed asset grew by 172.6%, a lot. Okay, then total assets, I think next item is total assets, so I can drag it down. Total assets increased by 95%. 100% would have been double, 95% is almost double. Okay, like this. All right, and because we are comparing item to item and comparing to the previous year, we can actually drag it across and get 2019 number. Okay, all right. In the balance sheet side, it's the same thing. We have just to be careful about items. Accounts payable, notes payable, accruals, total current liability. So in 2018, it is this year's value divided by last year's value minus 1. Okay, accounts payable, notes payable, accruals, and total current liability. I think these line up pretty well. Okay, then I think long-term bond comes right after it. Then it is long-term bond, so you can drag it down. But so long-term bonds increase by 209%. Okay, then the other item is total common equity, which is, it skips these two items, just shows the sum, which is E44 divided by D44. Okay, so which is E44 divided by D44. So it increases by 84%. And the next item is total liabilities and equity, so I can drag it down, and I can actually drag it across because I don't have anything to lock there, like no cell remains fixed. We're comparing item to item, okay, not to total assets. Okay, but always check that you are doing what you are thinking you are doing. Okay, so what do we learn from here? What do we learn from the ratios here? One thing is, okay, one important thing you can look at is how much revenue is likely to increase compared to assets, right? So you want, if you make more investments, you better sell more. Okay, which we'll be able to do only after we do the same thing for income statement. Let's look at the growth rate in different income statement items. So 2017, you cannot do comparison. 2018 net sales compared to 17 was 18 sales divided by 17 sales minus 1. All right, sales increased by 70% in 2018. Then cost of goods sold, depreciation. Okay, so sales, cost of goods sold, depreciation, other expenses. So cost of goods, net sales, cost of goods sold, depreciation, other expense. All right, so one thing you can see blew up is depreciation item. Okay, then what is next? Other expenses are D53 divided by E53 divided by D53 minus 1. Okay, the next item is total operating cost, which we don't have here. We have EBIT. EBIT is E55 divided by D55. So EBIT is E55 divided by D55 minus 1. Okay, then I think it goes like this. Interest all the way, interest, then pre-tax earnings E57 D57 minus 1, E57 minus D57 minus 1. Taxes will be also decrease. Net income will also decrease by the same proportion because it's proportionate after that. Okay, so I think these are okay. Then drag it across. All right, so this is what we see in the income statement changes. Okay, so what do we see here? One thing you can infer is, okay, so from 18 to 19, if you look at from 18 to 19, sales have increased by 20% in 19 compared to 18. But if you look at total asset increased by 21%. Okay, so in 2019, asset increase and sales increase are kind of going hand in hand. So asset utilization here seems okay. However, in 2018 compared to 2017, total asset investment grew by 96%, whereas investment sales only grew by 70%. So the growth rate in asset, hence investment, is more than growth rate in sales. So asset utilization, again, you can see is kind of a problem here. Okay, EBIT, because it was a negative in previous years, it's kind of blowing up. It actually doesn't mean much, but you can see how different types of assets are growing and how they are contributing to the growth in like income statement items. Okay, let's wrap it up here with the conclusion that so we have done ratio analysis, we have done common sized statements, but with similar flavor. Its common sizing is also kind of a ratios, right? But again, like I said in the beginning, ratio analysis does not give you the final answer, but it gives you opportunities to ask questions about, okay, so why is liquidity ratio low, right? It could be many reasons. One, this company will be unable to pay its short-term obligations in time. Other could be this company actually is able to increase its current liabilities more. For example, this is this company is able to purchase stuff on credit more, or has power over its suppliers than other companies in the industry. So in fact, we are kind of assuming that a higher current asset divided current liability is a good thing, but a lot of powerful companies in the world have a very small current ratio, including Walmart and Target, because they don't need as much liquidity. Okay, because they have power over their suppliers, they have power over their customers, and so on. So you have to think about like ratios are not a final answer. Ratios can be manipulated with short-term performance matrices and so on. And there are other things you need to consider about companies. For example, whether its revenue sources are diversified, or there are only a few customers having a large share, and so on. What is the competitive situations? What is the regulatory issues? What regulation it's likely to face. So for example, the ratio analysis will not tell like the future of, for example, fossil fuel right now, right? Because you don't know what the future is going to be given current administration and so on. But these are like basic things which will allow you to, let's say, ask right questions. Okay. Thank you so much. And this concludes this presentation.